a securities fraud scheme that netted its CEO and CFO $100 million, a false valuation concocted from home-cooked metrics, over $800 million in insider selling, all premeditated with years of lies and false disclosures. These are just some of the shocking allegations in an ongoing class action against UiPath, its founder and outgoing CEO Daniel Dines and its CFO Ashim Gupta. If proven true, this could be the worst pump and dump scheme in recent history. UiPath, the world's leading RPA software company, has seen its share price crash 90% within just 1 year of their IPO, from a peak of $90 a share to as low as $10 a share, wiping $30 billion off its valuation. To put this absolutely disgusting loss into perspective, if you bought Bitcoin at its all-time high and then sold it at its all-time low, you could still have more than twice the money as your UiPath investment. Some analysts believe that this catastrophic crash in stock price is due to AI disrupting UiPath's business, and UiPath's pathetic attempts to rebrand itself as an AI company seem to agree with this. But many investors are alleging that there's something more sinister going on, and now they're suing UiPath for securities fraud. In this video, I'll talk about how UiPath could get their IPO pricing so stupidly wrong, and whether their executives knowingly lied to investors for personal greed. And along the way, we're going to learn exactly how UiPath destroyed their own future as the result of a long string of terribly poor decisions and questionable ethics.
Daniel Dines.
Well, hello everyone.
Quick disclaimer, I'm not affiliated with UiPath or any of its competitors. I've never owned any related stocks, and this is not investment advice. I'm just a regular UiPath user sharing my opinions on this case. Back to the video. Before getting into the meat of this lawsuit, let's find out who UiPath is up against. It's this law firm Robin Skeller, and they're very good at their jobs. They have recovered $5.3 billion for investors in the last 3 years alone, and are known for massive settlements including $7.2 billion from Enron. But startups at IPO are by their very nature unproven and unprofitable, and proving misleading disclosure is extremely difficult, as IPO investors of the struggling trading platform Robinhood found out when their lawsuit was dismissed in February of 2023. But this UiPath lawsuit is not your typical shareholder class action, and the allegations are quite extraordinary. So just how explosive are the claims? Let's find out. This ongoing lawsuit charges UiPath Inc., its founder Dines, and its CFO Gupta with multiple counts of securities fraud for losses suffered in the year following the company's IPO. If UiPath fails to win the case, they can potentially lose a whopping majority of the $1.5 billion raised, with the possibility of criminal charges. It is alleged that UiPath made false and misleading statements and failed to disclose key pieces of information to their investors. It is also alleged that they did this to create artificial inflation in the stock price, which they then exploited for personal gain. It is suggested that the IPO structure was maliciously rigged to allow insiders to dump tens of millions of dollars of UiPath shares above IPO prices as soon as the offering was completed, rather than being subjected to a 180-day lockup period as is customary for IPOs. In fact, company insiders and their largest backers sold over $810 million worth of shares in the IPO, making up over half of all shares sold. CEO Dines personally sold $80 million, while CFO Gupta sold over $13 million of stock at or above IPO prices.
And now he's living in New York. I think he's got a swimming pool and all sorts of things.
And guess what? It is not just one allegation of false disclosure. There are 5 claims made against UiPath, some that I expected, and some that are extremely eye-opening. Let's go through them one at a time. UiPath had enacted a widespread discounting program prior to its IPO, which had the effect of temporarily boosting UiPath's revenue and annualized recurring revenue metrics, cannibalizing its future sales, eroding UiPath's margins, and increasing the risk of client churn. For software as a service or SaaS companies like UiPath, UiPath, discounting doesn't mean some Walmart half-price specials that make us want to buy a bag of chips right now. So why are they discounting, and what does it have to do with fraud? As a startup, UiPath cares more about growth, so they don't really mind losing money in the present. They're even eager to give out free trials and cheap licenses because every new customer can be transformed into recurring revenue for the next 5 or 10 years. Put simply, higher recurring revenue means higher valuation. The lawsuit alleges that UiPath exploited a two-part scheme to create some truly magical IPO numbers. By aggressively discounting in the lead up to the IPO, UiPath could blow sign-up momentum through the roof at a low cost of acquisition. The financials do seem to fit this theory, with a near doubling of revenue in 2021 while somehow spending 20% less on sales and marketing. Discounting is also conveniently shrouded in secrecy and protected by stacks of NDAs. This level of secrecy is so other customers can't try and secure better deals, and competitors don't know the price points to lure customers away. In fact, this pre-IPO discounting was only disclosed by CFO Gupta in September 2021, 5 months after the IPO. But discounting isn't sustainable. It's also a well-known fact that untargeted aggressive discounting is a terrible growth strategy, with some claiming it reduces customer lifetime value by over 30%. This is because customers that signed up with aggressive discounts are more sensitive to price and churn away much earlier. Most importantly, it sets an expectation that the product is not worth as much as stated, thus devaluing it in the customer's eyes. According to the lawsuit, UiPath took things one step further by offering ramping contracts to customers that grew in price from year to year. These forecasts conveniently did not consider the higher risk of customers leaving due to prices ramping up. But the secret sauce was actually UiPath's unique definition of ARR, the one that they instructed investors to focus on, one that they completely home-cooked. It was a method that averaged out the lucrative later portions of these ramping contracts over the initial period, thus faking the appearance of growth. And this magical scheme would have worked out perfectly and kept investors so happy if only these silly customers never leave. But leave they did, for so many reasons. Starting with this next claim, UiPath's actual total addressable market was not as large as portrayed by defendants because many companies included in UiPath's market survey did not need the type of high-cost, high-functionality automation products offered by UiPath. This actually clears up a lot of confusion around UiPath's meandering business strategy, because over the years they have released a disgusting amount of seemingly random offerings across multiple verticals, just hoping that something might stick. It really is a jack-of-all-trades, master-of-none approach, and it has confused me for years. Until now. You see, UiPath has always marketed themselves as an additive product, where they constantly try to upsell modular capabilities to existing customers as they grow. But would this land and expand strategy have worked out for UiPath? The problem with it, and I think most UiPath users will agree, is that the additions are mostly useless and outrageously expensive. Let's take a look at one such module, Document Understanding. If competitors are providing near identical deep learning models that cost 100 times less than UiPath's implementation, which one would you pick? And while UiPath exploits their vendor lock-in to sell these overpriced products, their main products that these add-ons rely on, Studio and Orchestrator, never seem to receive the budget or attention that they desperately needed. And then it finally hit me. What I had perceived as product fragmentation as a lack of strategic focus was actually UiPath attempting to increase their total addressable market. In the prospectus, they calculated their total addressable market in 2021 as over $60 billion a year by including every single company on planet Earth with over 200 employees. They then multiplied that by the recurring revenue earned from the top 10% of these customers. This seems awfully dishonest when in the same prospectus, they claimed that the same top 10% of customers contributed a disproportionately large amount of revenue to the extent that they risked business failure if they left. My other problem with this method is more of a common sense check, since the majority of UiPath's self-defined market would be the smaller companies with between 200 and 5,000 employees. That's a huge gap. And you might have already noticed an outrageous logical fallacy here. They're applying the revenue of a 5,000 employee company that's in their top 10% of customers to the more common 200 employee companies that have few use cases for automation. Surely CFO Gupta would have spotted this outlandish flaw and prevented an accounting disaster. right? Sadly, the answer is no. Gupta even doubled down on this insane calculation, saying that they had triangulated it multiple ways and independently verified it as well. That sounds a lot like, trust me bro. Anywho, I'm not 100% sure, but I think the independent verification might be from this Bain & Company think piece, conveniently published just 1 month before the IPO. UiPath corroborates their total addressable market with just a single, possibly out of context, line from this report, which says that broader hyperautomation platforms could increase their addressable market from $25 billion to $65 billion. Well, we all know better than to trust IT analysts, but just for comparison's sake, Gartner and Forrester both forecasted the RPA software market at a more reasonable $2.4 billion in 2021. So why is there a 30 times difference in market size? Well, back in 2021, UiPath was making most of its revenue as a glorified low-code task runner within this $2.4 billion RPA industry. Instead, their IPO pitched a vision to become a leader in hyperautomation, a $60 billion market that covers all of AI, process mining, analytics, machine learning, natural language processing, intelligent OCR, computer vision, and so on. Ridiculously ambitious? Yes, but having ambition is not illegal. The real question here is whether or not UiPath promised an unrealistic vision that could not be backed up by market research or hard data. If their upsells of these hyperautomation add-ons were indeed the result of unreasonably aggressive discounting, then wouldn't that be seen as misrepresenting the actual demand? Demand which may have evaporated as soon as pricing increased, when customers realized that they didn't even need the add-ons. Demand that could be easily satisfied by bigger players that were already making inroads into the RPA game. UiPath was losing customers to Microsoft, ServiceNow, SAP, Salesforce, IBM, and other established enterprise software vendors that were building automation into their platforms. To understand this, we need to look at the robotic process automation industry where UiPath was born. These are tools that basically interact with all the different business systems to automate repetitive employee tasks. To give UiPath credit, they actually destroyed their initial competitors in RPA, which included incumbents such as Blue Prism and Automation Anywhere. Their offerings in this space were arguably the best thought out and functional at the time. But RPA is just one tiny slice in the much greater citizen development pie, which basically refers to any tools that enable non-developers to make enterprise automations and applications. Think about the megacorps that created the actual business systems being automated by RPA. Yep, established enterprise software vendors like Microsoft, ServiceNow, and SAP. Why would they continue letting their customers rely on tiny third-party RPA vendors such as UiPath when they could just build or acquire their own native no-code and low-code tools? It's a no-brainer from a revenue and customer satisfaction perspective. So it should come as no surprise that SAP acquired RPA company Contextor in 2018, Microsoft acquired RPA software Softomotive in 2020, and ServiceNow acquired RPA platform IntelliBot in March 2021. With all of this happening before the UiPath IPO, would Dinez and Gupta factor the collective power of these big scary companies into their valuation? Or would they just turn a blind eye? Well, what UiPath told investors was that they mainly had to compete against very specific types of companies, namely RPA and automation lifecycle technology providers. While they made some blanket statements about other emerging competition, they didn't really seem to worry about these megacorps. In fact, CEO Dinez completely dismisses these threats as cheap companies that sprinkle the term RPA around. Is this sheer arrogance or gross ignorance? Or perhaps it is indeed recklessly misleading and materially false, as alleged by the lawsuit? I'll let you decide, but I think the next claim will help make up your mind. UiPath was losing customers due to the increased availability of low-code automation software offered by vendors such as Microsoft's Power Automate software, which were capable of addressing the majority of customer use cases at a fraction of the price of UiPath's products and services. Being in the industry myself, this one comes as no surprise because most insiders, well, everybody except for Daniel Dinez apparently, already respected the threat of Microsoft's Power Automate. It does make me wonder though, if UiPath adequately performed their market validation, and if they did, why did they choose to ignore it? Did they really understand their customers enough to justify their additive product strategy? Because in hindsight, the huge success of Microsoft's Power Automate offering appears to be the complete opposite of UiPath's strategy. They haven't built in tons of features or the ability to customize everything or even any add-ons. In fact, it took them years to just add in basic orchestration. Even I was frustrated by their speed of development reason, but as it turns out, most companies and users simply didn't need the extra features. They just wanted an easy-to-use, frictionless product that didn't constantly try to upsell them garbage they would never use. And this begs the inevitable question: did UiPath knowingly adopt and maintain a losing strategy rather than adapting to the needs of the market? Well, Daniel, I'm not sure it's as clear as you think. And all of this leads up to one of the most optimistic viewpoints I have ever heard in enterprise software. UiPath was suffering from a loss of channel sales due to strained relationships with UiPath's partners as a result of increased competition between UiPath and these partners. The prospectus told investors that UiPath would be saving on marketing costs by using these channels, that they're supposed to be a critical component of the overall sales strategy and contribute substantial revenue. Did UiPath really think that somehow these megacorps building their own RPA capabilities would be thrilled to do free marketing on behalf of UiPath? Especially when UiPath is consistently launching new products in mutually contested spaces such as AI to compete against these precious partners. It's hardly a partnership worth bragging about when both sides are actively undermining each other. Not to mention, these partnerships probably aren't binding, and they're definitely not exclusive. In other words, they're just worthless. Ultimately, these last few points hinge on UiPath already knowing about losing their customers and sales channels prior to IPO. I don't know if that's true, as I can only go off information in the public record and my own experiences, but the timeline presented makes for some damning reading with the alleged false disclosures stated against actual earnings. Obviously, it would be inappropriate and pointless for me to speculate on the outcome of this particular lawsuit without hearing UiPath's side of the story. Their lawyers, Davis Polk, are waiting for the appointment of a lead plaintiff before responding, after which they could drag the case through the courts for years. But I do appreciate the difficulty of proving misleading IPO disclosures. I mean, just look at these pages of risk factors and disclaimers written by God knows how many lawyers, and that's assuming you can't even get past safe harbor protections for forward-looking statements. To litigate this successfully, you might even need to go as far as to prove malicious intent, not just negligence or incompetence. I've read the entire lawsuit, and I think it has plenty of merit, although I do hope that there's enough internal documents and whistleblowers available to really build a watertight case. But the truth is, we shouldn't focus on whether or not the courts find UiPath's actions to be illegal. They're unfair, and in my humble opinion, horribly unethical. And many users feel that this toxic culture has seeped from leadership through to every aspect of the company. It's behavior like this that disillusions us, that makes us lose all of our faith in the RPA industry, an industry that only exists because of users like us and our passion for automation, because nobody actually wants to see UiPath die, or any other automation software company for that matter. What we need is collaboration and innovation. I just hope that this is a wake-up call for the current leaders of UiPath, or the new leadership depending on how the lawsuit goes, because you guys sold us a dream of automation software that is open, easy to use, and democratized. You need to do better. The thing is, I've always felt that UiPath did not care about its users because their flagship product is so clunky and outdated. So check out this video where I'll expose the questionable origins of UiPath Studio and explain how anyone can build it for free. I'll see you there.